Let's take us through what exactly you expect today.
Dom, good morning. Yeah, it's been a quiet earnings week, and it will be, but there's plenty happening to move markets. And coming off the inflation numbers, it really sets the stage for a cut next week. And yesterday's comeback, yeah, it's the largest in 2 years I think we've had in the market. Shows it's possible we had already priced in a 50 basis point cut, but we're expecting a 25 basis point cut next week.
Okay, so 25 seems to be consensus at this point. What exactly does that say, and what that kind of brings us to your word of the day? Can you take us through what it is and why in the context of that Fed decision?
Yeah, so word of the day is gradually. And as much as we'd all like to see an aggressive decrease in rates, we think the Fed is going to gradually cut, guiding us into a soft landing. With that, investors should really reevaluate their allocations and gradually shift from the heavy cash money market, short-term fixed positions within their overall portfolios.
All right, so now let's take us through where they shift to if they're getting out of cash and some of those shorter-term Treasury type securities.
Yeah, and, don't make drastic changes within your portfolio is our advice to clients, and especially before the Fed makes their decision next week. But we fully expect this rotation to traditional value continuing. And having said this before, we've advised clients that with this wind at the back of the value dividend defensive play, it sets up perfectly where you can have lower risk equities, rates moving down, which we haven't seen in some time and will probably be here for a while. You've got to be patient. You've had to be patient over the past 2 years in that area. But the sectors we really like, and they've led year to date, quarter to date, and I think over the past month, consumer staples, financials, utilities.
Okay, so if those three sectors are the big ones, we got just a few moments left here. Matt, what's your top pick?
Briefly, Target, consumer staples. If we had to pick one, we'd be looking at Target. Mainly, the valuation looks excellent, and they've kind of returned to a growth mode. Dividend growth over the past 10 years is great. Morgan Stanley and financials, they haven't participated in the market gains as much as the general financial sector. And again, dividend growth it's over roughly 25% over a 3, 5, and 10-year period. And NextEra Energy.